While you obsess over saving pennies and buying assets at a slight discount, apex predators use cash-settled derivatives to secretly corner a market. They force trapped enemies to hand them 10 billion euros in pure cash just to survive. Today, you will learn how to weaponize information asymmetry and paper contracts to break your opponent's balance sheet. The amateur believes wealth is built by predicting market direction and buying low. That is a loser's game. The titan knows true wealth is extracted by engineering a structural trap where the counterparty is mathematically forced to buy from you at any price you dictate. By the end of this private lesson, you will master synthetic equity and structural leverage to quietly choke an asset's supply. You will learn how to weaponize blind spots and execute an infinite squeeze that transfers their assets onto your balance sheet. We start where beginner finance channels end. If an idea appears in a cheap airport book, it is beneath this channel. No talks on saving salaries, compound interest, or budgeting here. You are here to learn the real machinery of economic dominance. Look at Mechanism 1, Stealth Accumulation via Synthetic Equity. How do you buy a controlling stake in a massive target without letting the market or regulators know you are coming? In every financial system, regulatory disclosure thresholds force you to report your ownership once you cross a specific percentage, usually around 30%. Regulatory disclosure threshold means the legally mandated share ownership level where an investor is forced to broadcast their holding to the public. If the market sees you buying physical stock, the price spikes, eliminating your discount. So titans bypass physical shares entirely using synthetic equity. Synthetic equity represents paper contracts that give you full financial exposure to a share's price movement without holding physical stock in your brokerage account. Think of derivatives as financial agreements whose total value is derived directly from an underlying base asset, like stock options or swap agreements. In 2008, sports car builder Porsche set out to take over Volkswagen, a massive conglomerate 15 times its size. German law required any investor acquiring 30% or more of physical shares to launch a mandatory public takeover bid. Porsche bought 42.6% in physical Volkswagen stock openly, but that was just the bait. Behind closed doors, Porsche contracted major investment banks to purchase cash-settled call options representing another 31.5% of Volkswagen. Cash-settled call options are contracts that pay the buyer in cash when the stock rises, without forcing the buyer to ever take physical delivery of shares. Because German law at the time only required disclosure for physical stock holdings, Porsche's 31.5% position was completely legal and totally invisible. They secretly accumulated controlling economic interest in 74.1% of Volkswagen, while short sellers believed only 42% was locked up. To secure those options, Porsche put up collateral assets pledged to guarantee loans or contract performance with top global banks. They leveraged their capital using borrowed firepower to amplify a position so that a modest sports car maker held a giant by the throat. Why did hedge funds fail to spot this? Because they looked only at public database screens, ignoring hidden derivative channels. Arrogant money managers thought VW was overpriced during the global financial crisis, so they aggressively sold it short. Do you see the trap assembling? The market was operating on public numbers, while Porsche was operating on reality. Never build strategy around public data alone. If everyone can read your thesis on a terminal, you hold zero competitive advantage. Now look at Mechanism 2, Float Constriction and the Short Trap. To understand how to crush a counterparty, you must understand cap table mathematics and free float constriction. A cap table, short for capitalization table, is the master ledger detailing who owns every percentage point of a company. Free float represents the actual number of physical shares available for the public to buy or trade on open exchanges. Let us examine Volkswagen's exact cap table structure in October 2008. Porsche held 42.6% in physical shares. The state of Lower Saxony held a statutory 20% block that by German law could never be sold. Add Porsche's hidden 31.5% in option contracts. That meant 94.1% of Volkswagen's total equity was locked in concrete vaults. Subtract 94.1% from 100%. The remaining real free float in the entire world was exactly 5.9%. Now look at the short seller's trap. Short interest represents borrowed shares sold by traders who are legally required to buy them back later. Believing VW was bloated, hedge funds had shorted 12.8% of Volkswagen's entire corporate shares. Do the math, the hedge funds owed 12.8% of the company, but only 5.9% of the company actually existed for public sale. They were legally obligated to buy back twice as many physical shares as existed on the planet Earth. A short squeeze occurs when rising prices force short sellers to desperately buy shares at any cost to cover their naked positions. When a short position goes wrong, losses are theoretically infinite because there is no ceiling on how high a share price can be driven. The London hedge funds had walked directly into a slaughterhouse they did not even know was built. They were trading on leveraged borrowed capital, making their vulnerability total when lenders called for cash. They fell into the builder trap, focusing on surface-level models while ignoring who owned the underlying choke point. You do the same thing when you optimize a product or app without owning the distribution channel or securing key agreements. If someone else holds the choke point, your hard work simply builds their eventual payout. Understand this rule, control the choke points, or be crushed by those who do. Now look at mechanism 3, the extraction selling the rope. On Sunday afternoon, October 26, 2008, Porsche issued a calm, simple press release to the financial markets. They disclosed that including options, they controlled 74.1% of Volkswagen and added they were seeking strategic growth. On Monday morning, when the Frankfurt Stock Exchange opened, total chaos erupted across global financial desks. Hedge fund managers realized the terrifying truth. They were short 12.8% of a company with only 5.9% available float. Prime brokers issued immediate margin calls demands that investors deposit more collateral or face forced immediate liquidation of their trades. Liquidation means the automated forced selling or buying of assets to settle debts regardless of price. Computer algorithms systematically bought Volkswagen shares at whatever price seller demanded to close open shorts. Volkswagen stock exploded from 210 per share to over 1,005 per share in under 48 hours. For a brief moment on October 28, 2008, Volkswagen became the single most valuable corporation on planet Earth. Hedge fund managers were weeping on office floors in Mayfair and Manhattan as billions evaporated hourly. Then Porsche stepped in with calculated, gracious mercy. They released up to 5% of their shares back to the market. They sold those shares to desperate, trapped hedge funds at peak price, extracting approximately $10 billion in pure cash profits. They did not fight their opponents. They sold them the exact rope required to prevent total liquidation. That is how wealth is transferred at the top, by engineering mathematical traps and owning the only exit door. Now look at the second pillar, character and strategic silence. Financial mechanics without self-command will leave you broke. Strategic silence is your ultimate defensive armor. Porsche's executives maintained absolute information discipline for months while Wall Street publicly mocked them. They did not boast at dinner parties, post online, or brag to journalists. They let their enemies operate on outdated assumptions. They compartmentalized their deal teams. Separate banking groups executed individual option legs without seeing the master architecture. In high-level finance, bleeding information is bleeding capital. Every time you leak your strategy, you sell your edge for $0. Look at yourself. You post your ideas on social media, seek validation from peers, and leak software builds before securing distribution. That is amateur conduct. Secure the position, lock the choke points, sign the agreements, and let the results speak when the trap snaps shut. You are going to fix this discipline today. Here is your direct order. Select one target business, competitor, or asset you intend to corner or acquire. Map its complete cap table and identify the structural choke points: who holds the debt, who controls the equity, and what is the real float. Write a one-page memorandum detailing how you can build a synthetic position via distressed debt, warrants, or exclusive supplier contracts to gain choke point leverage without public disclosure. This memo must be completed by 8:00 a.m. tomorrow morning. Do not touch your phone or open social media until it is finished. I know the excuse you are making right now. I do not have billions of dollars to buy complex derivatives or corner public companies. Stop whining, mechanics do not care about scale. The laws of leverage, cap table, choke points, and synthetic positioning apply identically whether you are acquiring a $2 million local supplier's debt or cornering a $100 billion conglomerate. Quietly acquiring a struggling rival's debt from their bank gives you total ownership control the moment they miss a single covenant payment. That is synthetic equity at a smaller scale, controlling the underlying asset through secondary contracts while the owner sleeps. Stop acting like a helpless victim of capital. Master the contracts, map the choke points, and execute. Remember this rule for the rest of your career. Never interrupt your enemy when they are aggressively shorting an asset you already secretly control. Execute your assignment tonight before 8:00 a.m. Subscribe to Wealth Code now, and I will see you in the next lesson.